Welcome to today's Explainer. Okay, we're jumping right into a topic that's literally everywhere right now, uncovering the hidden engine of the AI boom. You can't open an app or read the news without seeing something about the skyrocketing valuations of the magnificent seven tech giants. We're bombarded with headlines about artificial intelligence breakthroughs, next-generation chips, and these massive leaks in innovation. But if we want to understand what's truly happening, we have to look past the shiny silicon and the algorithms. We need to follow the raw fuel powering this entire machine. And you guessed it, that fuel is the money. So that naturally brings us to a pretty massive question. Whose money is actually funding the AI boom? Now, it's super easy to just assume, well, it's just standard corporate profits and pure tech innovation driving this, right? But when you dig into the source material, the financial reality pulling the strings behind the scenes is way more complex. It's much more global, and honestly, it is absolutely fascinating. Let's lift the hood and see what's actually going on. To start, we need to establish the sheer scale we're talking about here. Look at this number, $450 billion. Last year, U.S. tech giants poured about $350 billion into capital expenditure. This year, they're projected to hit an unprecedented $450 billion. I mean, they're building the infrastructure of tomorrow at breakneck speed. But here's the catch. In an economy that's actively fighting inflation and navigating a bunch of other headwinds, where exactly is nearly $500 billion in cash coming from? Well, to put that $450 billion into perspective, you have to look at U.S. internal bank loans. And when you do, that massive tech spending suddenly looks like a drop in the bucket. The liquidity flowing through the U.S. banking system has recently swelled to a staggering $2.5 trillion. We're talking about a 10% jump in just a few short months. The crucial takeaway here is that just a tiny fraction of this domestic bank lending could easily cover these massive tech investments multiple times over. The ceiling for tech spending isn't bound by just their profits. It's essentially being dictated by this massive, ongoing expansion of credit. Now, to really grasp where this ocean of liquidity comes from, we have to talk about a macroeconomic framework called modern monetary theory, or MMT for short. In simple terms, MMT argues that governments that issue their own fiat currency, like the US dollar, can essentially print money to drive economic growth. Because the currency isn't pegged into physical gold or anything anymore, its absolute value is fluid. So under MMT, the government doesn't necessarily need to panic about the size of its deficit right away, as long as they use taxes later on as a tool to pull money back out and control inflation. The source material actually uses this brilliant analogy to explain it. Think of government debt like a bathroom scale. If you step on the scale and it says 100 kilograms, but you're pure muscle, all your vital organs are healthy, and you're just in peak physical shape, well, that 100 kilograms is just a meaningless number on a machine, right? In MMT, the national debt is just that number on the scale. The theory argues we really shouldn't fixate on debt to GDP ratios hitting 120 or 150%. Instead, the focus should strictly be on the function and economic health of the body. Basically, print the money, build the muscle. But here is where things get really wild. There's a massive contradiction happening. According to the MMT rulebook, if you print all this money and it leads to high inflation or excess idle cash, you are supposed to use taxes to pull that cash back out of the system. You cool things down, tighten the valve. Yet, in reality, U.S. policymakers are doing the exact opposite. Instead of raising taxes to balance out the massive money printing, they've been actively slashing them for corporations. Let's break down exactly how that looks. Historically, the U.S. corporate tax rate sat around 35%. Then, it officially dropped to 21%. But, and this is a big but, because of various deductions, credits, and systemic incentives, the effective marginal tax rate is often way lower. We're talking about what corporations actually pay on new investments, and that number is frequently under 10%. So tech companies are allowed to grow rapidly, generate massive profits, and aggressively reinvest those profits without being weighed down by traditional tax burdens. They just keep the cash and plow it straight back into the boom. And honestly, that brings us to a really deep irony highlighted in the sources. With an effective tax rate under 10%, the U.S. is actually taxing its massive tech monopolies at a lower effective rate than China, a country that obviously maintains a nominally socialist economic system. It raises a very valid structural question. While U.S. markets are booming, is this purely free market capitalism at work? Or is it heavily driven by highly planned, state-sponsored financial engineering designed to protect corporate growth at literally all costs? To add even more fuel to the fire, the government is handing out highly specific regulatory incentives. Take emerging critical sectors like aerospace, for example. the federal government now allows 100% expense recognition right off the bat. Basically, if you have the idea and a secure revenue stream, you can essentially grow tax-free by continuously reinvesting every single dollar back into the company. The government is intentionally sacrificing short-term tax revenue to practically guarantee that these U.S. companies dominate the global future. It's a massive supercharger for growth. So, when you zoom out, the whole machine becomes incredibly clear. Let's connect the dots. Step 1. The U.S. prints money and issues massive amounts of debt. Step 2. Corporations use that domestic liquidity to invest and grow almost entirely tax-free. Step 3. Because the government is running huge deficits to allow this, bond issuance stays high, which keeps interest rates high, keeping the U.S. dollar incredibly strong. And finally, step 4. For the rest of the world, a strong dollar means paying way more for oil, food, and basic goods. The U.S. is effectively exporting its inflation to the rest of the globe. What this all boils down to is a structural global wealth transfer. When global citizens face higher prices for imported goods because of a dominant U.S. dollar, their loss in purchasing power acts as a hidden subsidy. And that subsidy is exactly what's powering American corporate growth and tech dominance. The rest of the world's inflation is essentially the shadow cost of the liquidity powering the AI boom. This actually leads to a fascinating perspective from the source material regarding international retail investors. There's this argument that goes, we are structurally contributing, taking profits from U.S. stocks is a justified incentive we've earned. Think about it. If you are a global citizen absorbing the pain of imported inflation to indirectly fund this system, earning returns in the U.S. market isn't just pure speculation. It's almost like claiming a rebate. It becomes a completely justified incentive for the structural contribution you are already making to their economic engine. So, what does this all mean moving forward? Looking at a 10-year horizon, we aren't just dealing with temporary waves of inflation that will eventually recede. The analysis suggests we are facing a fundamental, permanent reset to higher asset price levels across the board. Because of this unstoppable liquidity machine, the baseline cost of literally everything, real estate, stocks, physical assets, is shifting permanently upward. The painful reality is that, while asset prices level up, everyday wage incomes often stagnate, making it incredibly difficult for the average worker to just keep pace with this new financial baseline. Zooming in just a bit, in the short term, say over the next 6 months or so, this massive liquidity will likely continue to provide an ironclad floor for the U.S. stock market. The policy elements propping it up are just too robust right now to fail. But looking slightly further ahead, there's a huge catalyst on the horizon: stablecoins. The integration of stablecoins into the financial system is predicted to permanently accelerate AI growth and infrastructure by massively speeding up the velocity of digital money. Once that integration fully takes hold, there is simply no going back to the old system. So there you have it. We've uncovered the hidden engine of the AI boom. It's a massive, debt-fueled liquidity cycle, theoretically enabled by MMT-style printing, but practically turbocharged by historic corporate tax cuts and structurally subsidized by global imported inflation. It's a lot to take in, but the question you really have to ponder now is this. As global asset prices permanently level up, how will you navigate this new economic reality? Understanding these hidden mechanics is the absolutely crucial first step. Thanks for joining me for this explainer, and keep questioning the systems around you.